Well, for more on today's top-line story, U.S. inflation numbers coming in lower than expected and igniting a stock market rally, we're joined by David Rosenberg. He's founder and president of Rosenberg Research. David, thanks a great deal for joining us. Yesterday, in your Breakfast to Dave note that you circulate to clients, you said in the lead-up to tomorrow's, i.e. today's CPI report in the U.S., the signs of global disinflation are growing by the day, not only in commodities, but in used vehicle prices and other areas of the global economy as well. And we've seen that in today's numbers. Used vehicle prices are a meaningful contributor to softer than expected U.S. inflation. What is your early take on what we've seen this morning?
Well, this is the first time in a long time that we saw the core CPI come in so dramatically below expectations. It wasn't so much the headline, because everybody knows that month over month we were going to get a hookup in gasoline prices. The core was the key. The headlines read plus 0.3, but it was actually to the second decimal place up 0.27. That's very significant because we were so accustomed to seeing the core CPI go up, 0.5, 0.6, 0.7 now for so long. But what I really noticed within the data, I mean, it's as you just mentioned, used car prices, but also new car prices, although they didn't decline, they slowed dramatically. And you saw declines in apparel, you saw declines in delivery services. And what's really interesting is that this weaker than expected number happened even with the rental component up once again rather dramatically. We all know that's a lagging indicator, the way that it's calculated by the Bureau of Labor Statistics. But what's key for me is that when you look at the whole index and you sort of strip out the supply side vagaries from food and energy, that's not demand, that's supply. And then you strip out shelter, which we know how it's calculated is it's a BS number. We already know that new leasing rates on the rental side in the US are starting to actually deflate. You strip out those three areas and the CPI was actually negative 0.1 month over month. Paul, we haven't seen that since May 2020. So I think we're starting to finally see a decisive break in the inflation uptrend line to the downside.
Okay, so the early takeaway from stock market investors in the U.S., as you know, is that they see the stock market also sees inflation declining. The market is now betting on a smaller rather than larger rate hike from the U.S. Fed in December. What is your view on where the U.S. Fed goes from here?
Well, I think at this point, looking at the state of the economy, which is weakening and will continue to weaken in 2023, and the Fed might want to see today's data point, confirmed in the next couple of months. I know that we're all celebrating and it's all jubilation today, not just in the stock market, but on the bond market. But Paul, you do remember that 4 weeks ago when we got the big upside surprise in the inflation numbers, it was like, the Fed was going to go take rates to the moon and things were selling off. It's an encouraging number. The Fed has already told us that they're waiting for a string of numbers just like this. So they're probably going to go in December. My sense is that they'll probably raise rates 25 basis points. I know there's people out there that think they'll go 50. I think that's unnecessary, especially when you consider that they're draining their balance sheet via QT to the tune of $95 billion a month, and they really haven't started yet on the mortgage market. And here we're seeing the housing market decay dramatically even without that. So my sense is that, and I think the Bank of Canada as well, I think they're going to go again in December. They'll go 25, a nice token move to keep all the inflation phobes happy. And I think that could be it. That could be it for the rate cycle. Is by year end, it's in the rearview mirror.
What is your markets like the prospect of an end to rate hikes, but they don't like recessions? What is your take on the prospects for a U.S. recession? Yesterday, you took a close look at a measure of small business confidence, which is tanking.
Right, and the point I made was that that's the NFIB Small Business Confidence Index, and it's at a level in the past that was consistent with recession. In fact, I was surprised nobody even mentioned this, but I snuck it into my daily, which is that particular reading was basically the same level that we were experiencing back in the summer of 2008. But I'll just remind you that before Lehman and AIG and Mother Merrill back in September of '08, the prevailing view even then was that there was no recession. Paul, can you believe that going into the summer of '08, the prevailing view was that we still had a soft landing? And yet we know with perfect hindsight from the NBER that the recession actually started in January 2008. Go figure. We probably are in a recession right now. I know it hasn't yet infected the non-farm payroll report, but it has shown up in the household survey, which has turned negative. So I think that the recession is already starting, and you're quite right. Stock markets don't like recessions. Fundamental lows in a recession bear market happen 70% of the way into the recession, and it's just starting. So enjoy today's rally. We've seen how many now, Paul? 5, 6 bear market rallies this year. S&P is still down 20%. And I think that'll be the story next year as well. The story next year won't be interest rates affecting the market multiple. It'll be the economy affecting corporate earnings. So there's another big down leg. So enjoy today's rally, but it's probably going to be a rather brief affair. We'll forget about this inflation number in the next few weeks, and we're going to start to see, I think, cascading negative economic data and earnings disappointments and downgrades, and that's really going to be next year's story for the stock market.